What's up? I'm Dan Fredenberg, and this is another chance encounter.
Hey, what's up? I'm Dan Fredenberg. I'm a commercial real estate guy. I'm from the internet. We're seeing more properties like this being built in front of a house that's going to be torn down soon. I understand that there are power lines that are getting kind of close. What's up again? This is Dan Fredenberg, and that there is a commercial real estate building.
I'm joined today with TJ Burns. How you doing today, TJ?
I'm doing well, Dan. Thanks for having me.
Oh, definitely my pleasure. And I got a special, exciting bonus for you today, TJ. I don't know if you're aware of this, but today we are joined by my very favorite member of the audience. And why is my favorite audience member here? It's because this is a chance encounter where I interview commercial real estate players. That means deal sponsors, that means deal finders, it means investors, buyers, sellers, all that kind of stuff. And you may ask yourself, why would you do that? And the answer is, if you've ever heard of an off-market deal, these are the private deals that you're not allowed to publicly discuss with each other, then you should know that the SEC requires that you have a documented prior substantive relationship, or else they'll get ants in their pants and they'll shut your business down. So that's what we're up to right here. And the extra benefit to you is not only do you get to meet another person in the space, but you'll learn how to communicate more effectively on the subject of commercial real estate deals and understand how my guest fits into those. But before we get too excited about real estate, TJ, do you want to say a thing or two about yourself?
Sure, Dan. Yeah, I come from the tech world. That's what my career was in, engineering, and found real estate like many other people, was looking for ways to build wealth and invest extra cash. Along the way, have tried a number of different things, started with some single family, small multifamily, house hacking, and then discovered syndications along the way and passive investing, actually by finding a wallet on the street, and did that for a while and found that it fit, my lifestyle quite well, especially when I was working a demanding tech job. And eventually that morphed into something more when I started becoming more active in those deals and co-sponsoring them. And then that brings me to today, where I focus mostly on the capital side, raising capital into funds and partnering with other operators.
I love it. I love it. So, step number one was to buy 50 fake wallets and then drop them. You got my
It's a great
wheels spinning.
strategy. It
Right,
is.
right, exactly. It'll work. Yeah. All right. So, the first segment that we always do in these interviews is the five distinct motivations. Before we do that, though, I got to say, but wait, check your eight. Hey, TJ, you mentioned your tech background. I don't know if you can pull this off or not, though. Can you see through the camera and into the user's device down there? There might be this hideous subscribe button that maybe they should do something about. Okay, okay, yeah, right. It's a silly joke, but whatever.
Never
I'll
actually
do.
done that before in a video, but
Right? It's pretty sweet. It's kind of funny. It makes you feel like you're just hanging out right here in the screen. But anyway, the five distinct motivations, other than seeming like you live on a camera and inside a computer, the five distinct motivations, the reason why they're featured in these interviews, why I do them first, is because the fact is, these deals have plenty of risks involved. They take months to close, they take years to go full cycle. And one thing that's really important about people in this space is to have some sort of clear idea of what's going to keep somebody from throwing in the towel when the going gets tough. And even though I've now met hundreds of different commercial real estate syndicators, investors, buyers, sellers, all that kind of stuff, I find that everybody's unique why fits pretty neatly into these five categories. So I think you'll find them pretty helpful. The first one of which is preservation of purchasing power. What on earth is that? Well, some people are buying their commercial real estate acquisitions because they already have a portfolio of assets. They are job optional. They don't have to hold a day job. And so you may ask, why would somebody like that bother to make a new acquisition and go through all of that drama, which is inevitably part of the process? Well, the answer is there's a couple different big scenarios that pop out. One is if inflation is rearing its ugly head, then that's going to eat away from the purchasing power of the cash flow that comes from ownership of this portfolio. And so it's going to be time to make a new acquisition if that's the case. But the other circumstance is if there is severe distress or an asset crash or something like that, that should mean that you can buy at a very steep discount. Now, of course, everybody should try to buy their real estate at a steep discount just to make sure that they don't lose their principal. But basically, somebody who has the main motivation of preservation of purchasing power, they're not going to have to pull the trigger every 5 seconds, usually the same way that a lot of transactional REITs and stuff like that will. But I'm not that far in my commercial real estate journey. Where I'm at personally is trading time for wealth. I also have a background in technologies. For me specifically, was the CRM space, and I was building the online funnels for different online businesses in different sectors. And real estate ended up luring me away from that, and I started building those funnels for real estate for a guy who was flipping 10 houses a month. He was doing 10 single family house transactions every single month like clockwork for years before he ever hired me. And when I started to see that as you pursue a bigger salary, a bigger and better salary, your tax burden ends up becoming to the point where you're paying more in tax than anybody else. That's what made me pivot and say, hey, I should be more like my boss and be rewarded in the form of little slivers of deployed capital, aka equity, instead of just pursuing salary and then just giving it all in the form of tax. So that's what I'm up to. And I get that a lot of youngsters, that's a little too abstract for them. The more common answer, the more common motivation for people in when they're younger is that they want to take control of their schedule. And it might be the ultimate take control of schedule in the sense of hustling like crazy now and then fast tracking your retirement. But really, when it comes to this motivation right here, it's absolutely a very valuable way to think. We only have so much time on this earth, but when somebody really believes that or really wants to work fewer months per year or fewer weeks per month or something like that, one kind of caveat to keep in mind is some people think that that's secretly everybody's motivation is that they want to retire on a beach somewhere. But I assure you that is simply not the case. Some people are more motivated by ambition itself. They want to buy their entire hometown. They want that generational wealth to make sure that their great grandchildren never have to hold a day job. And that's why they're making their commercial real estate acquisitions. And in some circles, that level of ambition is highly vilified. But I don't think that that's entirely fair, because if you want somebody to actually take care of a place, make sure that they do not throw in the towel. People like this are great to have on your GP team because they're going to hustle into their 90s due to that motivation. Whereas the last group, they're also going to be motivated to hustle into their 90s, but it's just the focus is going to be different. They've figured out, they found a sector of society, or maybe the environment, maybe it's animals, but this last group of people, they realize that there's a financial component to making a really big impact, and so that's why they're making their commercial real estate acquisitions. So TJ, these 5 different motivations, what combination of them would you say describes you best?
Yeah, I think when when I was starting out in real estate, I was very motivated by the idea that one day I could retire early and do whatever I wanted to do at that point. And I don't think people realize what that looks like, and it's very hard to imagine when you're in the hustle. But as I've kind of progressed in my career and I've gotten to a place where financially I feel pretty good, my motivations have shifted quite a bit. V Less motivated by money nowadays, which money is of course very important and it does motivate people and make sure that you do a good job. And um, but my motivations have become more of just the satisfaction of trying to get really good at something. And I think a lot of people that are able to retire early, they're already very ambitious, and ambition isn't something you can really just turn off. And most of those people, they they get to the point where they can retire, and then they never retire. Like I'd say the vast majority of entrepreneurs are this way. And you see them and they go off and they hustle on their own thing like crazy. They work 12-hour days, they're all over the place. And you wonder, you say, oh, well, that person, they're always touting that, you can get to this point where you can retire. Um, and I think the reason for that is money's just not, it's not a satiating thing. A lot of people get to the point where if they are motivated by money, they just feel like they need more and more and more. So yeah, for me, it's really just become realizing that I'm motivated the most by the work itself, and kind of the satisfaction of devoting a lot of time and effort towards something and seeing it grow.
Fantastic answer. It's inspiring, quite frankly. I just love going like the detail that you did to going in there. And one of the things that I usually do at this segment is I say, now I get that that sounds very optimistic and wonderful and all that kind of stuff. Some people, get really heartfelt, a little bit teary-eyed talking about their motivation, but there are risks involved, and so we need to have that grown-up conversation as far as what is too much risk, when do these numbers just become more danger than a positive effect. Now, if you've ever been involved in a private syndication, the 506B deals, these ones that you're not allowed to publicly discuss, then the SEC attorney who, in other words, the securities attorney who's involved in the mix, they should have insisted that everybody involved in the investment filled out this highly invasive suitability questionnaire. It's a financial questionnaire. It asks all sorts of questions that you're not going to be comfortable answering, like what's your net worth. But one question in particular stood out when I went through the questionnaires because I found that it lacked utility. It didn't matter which of the answers you gave, I felt like I couldn't really trust the answer. So I made my own one, which is a fill in the blanks question. And here it goes. There are many popular investment asset classes, but I think blank is too risky. So TJ, it can be inside real estate, it can be outside real estate. You can give one of each if you want, but what's too risky for you?
Yeah, I mean, I think I'd first have to uh one, I'm gonna leave out anything that I don't have knowledge of, right? Because for instance, everybody likes to pick on crypto. Like crypto could be risky for one person, but for another person who has a lot of experience and knowledge and know-how and connections within crypto, it could be not that risky, right? So for me, I focus on things that I understand well and I feel like I have some sort of advantage in, which through my business has been, things related to real estate. But I also have a lot of knowledge in the tech space, given that I've worked in it. And I'd say that hardware companies are very, very difficult to make money in. And I would probably say a hardware company is a little bit riskier than uh, what I'm comfortable with. And I think the important thing there too is to say like we're talking about risk adjusted returns, right? So I think the risk adjusted return for hardware companies is low because you're going to have a couple that do really, really well. I worked at one of those companies and it worked out fantastically, but you're also going to have a lot of companies that fail in hardware. It's just a very difficult business.
I love that answer. I love that answer. But that brings me to the next slide here. It's asking about your favorite deal metrics. And just so you know, for the first few hundred episodes of this, I did not throw this slide up here because I thought that it was a little bit too much of a fastball for some people. Specifically, you should be aware that some people in this industry, they're more front of house, they're the marketing person, they're the pretty face, whatever you want to call it, and they are not the people who are going to be doing deep dives into the underwriting and the spreadsheets and tweaking a couple dozen different numbers in order to figure out how to make the property profitable. But I started throwing this, including this slide, this segment into the interviews because even if you're in that situation, there'll be a few different metrics that you tend to hone in on and emphasize when you're talking to investors. And I just want to make sure that you are talking the same language as my guest. You emphasize the things that they understand best. And for anybody in the audience who's only listening and they're not watching, I'm going to read out the list. I've got 14 different metrics on here. It's not an exhaustive list, so if there's one that you rely on even more, feel free to use that. But here we go. First one is cash on cash, then IRR, which is the internal rate of return. Then you got the cost per door. This is fairly leaning towards multifamily specifically, but cost per door, it's one of the main reasons why people choose multifamily is because they're splitting they're distributing their risk among the different doors on the property. Then there's the net operating income. There's the going in cap rate, which is really talking about how much of a discount are you buying this property at compared to properties in its area, because there's a cap rate for each MSA, each major city and whatnot. So that discount is going to prove that you're buying right. The loan interest rate is especially important if you're going to be assuming a loan. Then there's the occupancy rate, which is the same but inverse as the vacancy rate. So in other words, how many of the units are filled. Then there's the average income where the property is located. There's the amortization period of the loan, which is especially important if you're going to be assuming a loan. Then there's the difference between the market and in-place rents. Then there's the population growth where the property is located, which means there's some baked in appreciation from demand. The sponsor record, which is how many deals have gone full cycle and how many are on the go right now. Then there's the waterfall split or exit strategy. In other words, what happens after your principal, your capital has been returned? Do you keep on getting returns afterwards, or do you basically get cut off once you hit certain targets? Then there's DSCR, which is debt service coverage ratio, which is how much of your revenue is going out the door immediately just to pay for the loan and whatnot. So once again, you can go ahead and add another one if you want, TJ, but you want to give like a top three as far as ones you tend to personally emphasize?
Yeah, I mean, I guess we're talking multifamily here. So, I was going to say cost per door before you put the list up. That's one metric where you you have complete control over what you're paying for these properties, whereas some of the other things maybe are market driven. Um, and as the saying goes, you kind of make your money when you buy. So if you're buying at a really good price, then not only are you insulating yourself from some sort of market downturn, but you're also leaving a lot of upside for when you sell it. So was going to say that, but then when you put the list up, I saw sponsor records on here, and I think that covers more of the intangibles of these types of investments, kind of like the human factor, which is a tremendous factor in these deals. And I'd probably include in that not only the sponsor's track record in doing the exact type of deals that you're investing in. So let's say if you're investing in a multifamily deal in New York City, which might not do that, but if you were looking at that sponsor's track record on multifamily in New York City, very important. But I think it's also important to look at that sponsor's life track record, you could say. So, who that person is, what their values are, what have they done in other areas of their life? Because that's probably going to carry over to this deal, and it's going to influence a lot of the other things up there, like your waterfall, which is kind of the terms that sponsor is giving you. So that's two, and the for the third one, I'd say um, cash on cash may or may not be important to somebody. To me, it's probably not top three. IRR, again, all these deals they're sort of in the same realm usually.
Mhm.
Um, I focus mostly on value add, so I'd say NOI is pretty important. And not the NOI when we buy the property, but really the NOI when we stabilize the property, because
Mhm.
that's what's going to drive a lot of the value in excess of whatever your cost per door is, which will
Mhm.
also bring a little bit of value.
Absolutely. Absolutely. I love it. I'm just eating up that answer like a delicious subscribe sandwich. That's definitely not um, totally intense. But it's the way that I remind myself it's time to pull out the Dan Does Deals Commercial Core Competency Cube. And it's got the 6 different roles in a commercial real estate deal. It's a little bit leaning towards multifamily. But the real idea is that it will help you more effectively communicate on the subject of commercial real estate deals because you'll know these different roles. And if you're looking at this cube as I give the explanation of the 6 different roles, it just takes a couple minutes, and you're saying, hey, I really need me one of those. Well, the good news is it's absolutely free. You hit up dandoesdeals.com. There's this big conspicuous looking button. You can just click on it and download it and print it out. And I want you to do that, which is why I committed the cardinal sin of marketing, which is you never give away your freebie without getting some sort of contact information in return. But personally, I want to make sure there's nothing in the way of you printing this out and practicing it on your friends and family. Because quite frankly, if you're thinking of making commercial real estate part of your career, your ability to effectively communicate is going to dictate your success. You really need to be able to explain this stuff really well. So let's get started. The most visible people in commercial real estate are definitely the repositioners because they're the acquisitions people. They're the social butterflies. They're going to be talking to absolutely everybody, and they're going to be underwriting a gazillion different deals. That means they're doing the math. They're figuring out, first of all, is the seller slash broker even telling the truth about how much that property is making? That's a little bit of a hurdle to start off with. But of course, the repositioner is ultimately doing all this math to figure out how can they make this property make more money than it is right now. And they've got a few different cards up their sleeve. Now, the first one I'm going to mention, it's a little bit counterintuitive, but repositioners always have a wide network of financiers, which are people who are not on a GP team for any properties because they only deal with paper, money, and the owners of the property. So that means these are the lenders and whatnot. And that is precisely why that network of lenders, the financiers, has to be so vast, is because if the repositioner can secure a more advantageous loan, that goes straight to the profitability of the building. Cheaper money means it's more profitable. So that's why they're always doting on different financiers, and that's what that's all about. But the next place the repositioner will likely look to find more upside is they're going to take a deep dive into operations. First thing they're looking for is to stop those Benjamins from going down the toilet. Of course, there's more to operations than just unclogging toilets and mowing lawns and collecting rents. As a matter of fact, if you focus on bigger properties, as I tend to personally, you're probably going to outsource the operations to a third-party property management. And that basically means that, well, what else is there really to do, especially if you're like Dan Friedenberg? And the answer is there's a few. One, my CRM background means that I can take care of different automations. The web asset background means websites and things like that are no big deal. But the bigger one to understand is that the enemy in all forms of commercial real estate is vacancy. It's those empty units. You got to get them filled. And even if you are outsourcing your property management to a third party, if they can't get the units filled, then somebody on the GP team has to have some serious marketing chops to get those units filled. So that's where people tap into my skills. But there's only so much you can do in operations to find more upside. So the next spot that the repositioner is going to check out is to get a contractor team involved to do a value add to upgrade the place, make the place nicer. And the whole idea being that if it's an upgraded property, then the next residents would be happy to pay more in rent than the previous ones. So that way you found that upside. But if only things were that simple, you can spend endless amounts of money on contractors and not get a return on your investment. For example, you can gold plate the toilets if that's your thing, but it's not a great idea. And there's more issues to keep in mind when you're dealing with a contractor team. And if you're like me, I don't know if you know this about me or not, but I'm from the internet. So that means I need a local. I need boots on the ground. Somebody who can be there in an hour or two, because you can bet that won't be me because I'm geographically challenged. I'd be stuck at an airport in an hour or two. So you definitely need to have somebody in your deal who can be there in an hour or two. Just hop in a car, find out what's going on, put out that, what do you want to call it? Hyperballistic fire is what the locals have to do. They need to make sure that the contractors are staying on schedule, they're not using subpar parts, making sure that the operations aren't sloughing their photos and whatever. But let's do a hypothetical for the next part. Let's say you decide to become a repositioner and you're thinking, hey, I'm an engineer or I'm a physician or an attorney or something like that, and I know how to buy a house. And that 350 unit apartment complex down the street looks pretty neat. So I bet if I went around my circle of friends and say, hey, let's put in 100K each, and we'll take over that building over there. You get it under contract. You turn around to the financiers. You say something along the lines of, I want to buy this building. It's tens of millions of dollars. You don't have, I don't know, say tens of millions of dollars. You want to say lend us? Well, the good news is there's, I'm going to tell you one of the things that the financiers are going to ask you that's going to rain on your parade. If you're in a mentorship program or you have a guru, I encourage you to listen very carefully to this next part, because the financiers are going to want to know, who's your sponsor? Who's your KP? What's that all about? So if you want to be eligible for a commercial loan, the banks, they have to make sure that you're not just going to use their depositors' money and then run the business into the ground. So they're going to insist that somebody in the fold, somebody in the GP team has to already own a similar asset, or you're not going to be eligible for the loan. So that means if you want to buy a 350 unit apartment complex, you got to find somebody who already owns a 350 unit apartment complex, and that's the sponsor slash KP. On top of that, the team needs to have a certain amount of liquidity, and then for collateral, the GPs need to have a balance sheet of at least the amount of the loan. But if you have all those pieces, you got yourself a commercial real estate deal. Now, once again, I mentioned that that's very leaning towards multifamily. So if you're focusing elsewhere, feel free to color in the lines there. But TJ, what sides of the puzzle are you most likely to contribute?
So my focus is mostly on raising capital. Like I said, I use the fund of funds model for that. You can think of me as a larger limited partner in the deals I do and the funds that I invest in. So almost like a small private equity company.
Mm-hmm.
Um, I have some small multifamily where I do all those parts, of course. I don't even have a property management team for that stuff. But yeah, with the deals that I do through my business, Burns Capital Partners, very focused on the investors, investor reporting, investor relations, due diligence, on the stuff that we're investing in.
All right, great. Financier relations. I love it. And honestly, my favorite part about commercial real estate is definitely the people. But before we get to the people, let's talk about the buy box itself of the property. Now, when real estate people are asking each other, hey, what you looking for? What's your buy box? What's an ideal property? We want to know three things. First one's geography. Where is it? Okay, so which state, which county, possibly even which neighborhood. Before you call it ideal, that's definitely going to matter. Second one's going to be size. Now, once again, we lean towards multifamily on this show. Most of my guests are in multifamily, the apartment complex investing. And the way that you define size in an apartment complex is by the number of apartment units. They call it unit count. The reason why it's relevant is because the type of group that would take over 10 and 15 unit apartment complexes, they're usually fundamentally different from the ones that are taking over the 150 unit apartment complexes. So that size will matter. Now, of course, other forms of real estate, they'll go by square footage or acreage, but that size comment still applies. So that's going to matter. Now, the third one, though, is called class. I don't like the term class just because it seems singular to me, and it's two completely independent things. The first one is the condition, the second one is the area. So I think desirability is a better term, but whatever. So when you're talking about condition, we're talking about how old is the facility, how old is the building, how beat up is the building, what sort of luxuries and amenities are present on site that make the residents really happy to be choosing that as their place to rent rather than somewhere else. That's the condition. But if you're talking about area, especially if you're talking about residential, which multifamily is still residential, the school districts are going to be very important where the property is located to increase that desirability. But regardless of the type of real estate it is, the crime rate is going to matter. And then there's also that famous broker trope of location, location, location. I don't like that saying because I don't think it tells you much. I think what they're really telling you is traffic, 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 which means if a gazillion people pass by that property every single day, it's going to be more desirable than one that is basically crickets all day every day. So the area and the condition, those are the desirability metrics, and the way that you rate them is the same way as in grade school, where you have A plus at the top, then A, then A minus, then B plus, and so on. So TJ, as far as you and your organization goes, what's easier to say yes to?
We look mostly for with multifamily again, B minus in a B plus area or C plus in a B area. It's mostly workforce housing, so anything, well, affordable housing to workforce housing, lower price point where we can look at other properties in the area that are, renting at a higher price point for, those folks that make more income or want a nicer spot. We're the option that's more affordable, still nice finishes, but more basic. And have done deals in the Northeast and the Midwest and the Southeast.
Okay, so great. So yeah, you said the states were yeah, cool. And the classes were good. So let's get back to people then. My reason why I think that real estate is fundamentally different from other industries, especially tech. Tech. We tend to be a little bit introverted and a lot bit antisocial. So we're not really eager to do networking events all day, every day, and meet hundreds and hundreds of people. At least the typical tech person. Whereas in real estate, people are very eager to meet more people, build new teams, make referrals, even if it's not going to be a team that they're included in. I chalk it up to the fact that it's multifaceted. You've got these six different roles, and nobody's going to be all six of them for any meaningful amount of time on a number of properties. But one of the main things is that even though we all are so eager to help each other out, because of our unique skill sets, we're still going to be better off helping some people than others, even though we're all ultimately in the business of deploying capital. So financiers are people that everybody in real estate is eager to meet up with. But for me personally, being from the internet, the sponsors and KPs are the people who I tend to want to meet the most, especially now that I am involved in a debt fund. So that means they're the ones that are going to have the established business where either as a GP, me hopping on, I can add my tech skills, my marketing skills, and all that kind of fun stuff, and really support the ongoing business that the sponsor KP has. Whereas when you're just getting started as a local or as a repositioner, you need grunts. You need somebody who can put in 80 to 120 hours a week, and that's simply not how I'm contributing the most is in that situation. So that's why I'm always eager to talk to sponsors and KP. TJ, you mentioned that you're in investor relations, so financier relations. So that's probably who you're focusing on. But of course, you're going to need other sides. I don't want to put words in your mouth. And don't mention any 506B deals specifically if you're asking for investors. But unless your fund is 506C and you're only taking accredited. But who are you looking for that's out in the camera right now?
Yeah, we do 506C deals, so we don't, we have 506Bs here and there. But mostly my business, I work with LPs, retail investors, a lot of folks in tech that are looking to diversify. And of course, I have my relationships on the sponsorship side. Although if you're a sponsor, I get a lot of those requests. So most of the time it's, we're building the relationship for years. I'm never gonna just partner up with somebody who sends me a deal. So yeah, a lot on the retail side, and then, like I said, a few sponsors.
Right, right, exactly. Yeah, when somebody emails you a deal and you're like, who's this now? That's not a good look. Like that, there's just no way. That's just absolutely crazy. So
Yeah,
thank you.
happens a lot though. I mean,
It really does.
people here, I raise money and they send me something and the numbers all look nice and all that. And they're like, yeah, would you want to partner? Basically saying, would you want to invest $1 million? And I appreciate the hustle, but the answer is always going to be no.
Absolutely, absolutely. So that's the people part. And so the last part has to be, how do people reach out? And I'm going to sandbag that conversation for a second, talking about myself. I'm fortunate to have this distinct looking last name. Means that I'm really, really easy to find online, especially on LinkedIn, which is the social media platform where I spend most of my time. And I ran into TJ on that platform. But if you are in the mood for some books on business related skill building, I've got a few of those on Amazon. One of them's on real estate. The other ones are more widespread, like developing your attention to detail and basically dealing with a horrible boss and finding that way out. But if you are going to be getting involved in investments, if you are going to be syndicating your own deals, if you're going to be raising capital, I highly encourage you to pause the video, scan this QR code right here, and that goes to the FAQs page of 506BME, where it tells you the details of how 506BME documents those substantive relationships, how it keeps those backups so that if your laptop falls into the bathtub, well, that's not a good enough excuse for the SEC for why you don't have documentation of your substantive relations. So that is what we're offering if that's what is something you're going to be doing. But TJ, if people want to reach out to you, LinkedIn, social media, website, phone, email, what's the best way to reach out?
Yeah, TJ Burns on LinkedIn, burnscapital.co. That's it.
Perfect. I love it. And that brings me to the very last thing, which is not for you, TJ. It is my public service announcement. If you've been watching this episode and experiencing searing pains in your eyeballs and like migraine like symptoms, I'm confident it's due to the downright hideous subscribe button that's just down. And you can get rid of the thing for free. You just click on it. And okay, full disclosure, I want a whole whack of people to hit the button, because if they do, then YouTube will actually start to pay for these videos instead of me. And I think that would be amazing. And the trade-off to you, just so we're clear, my videos may show up on your list of suggestions. You can feel free to ignore those suggestions, because quite frankly, I just appreciate the fact that you spent this time with me. Just like TJ, I appreciate you joining me today. This has been great.
Thanks for having me, Dan.
Awesome. Thanks. Hey there. Are you interested in commercial real estate deals? Would you like to build your network of investors and deal sponsors? Well, the best thing I can do for you is have you appear on a chance encounter interview as featured on dandoesdeals.com. You may know me from 506BME or as a top commercial real estate voice on LinkedIn. And if I had to think of the top factors in your success in commercial real estate, my top two would be your network and your ability to effectively explain how deals work with effective communication. The 15-minute chance encounter format, it checks both of those boxes, and they ensure that you can share your private deals with me without the SEC calling it a public solicitation. So hop onto LinkedIn. You can see my name is over here, Dan Friedenberg, and search for my name. And the best way to reach me and book that is to message me through LinkedIn. And don't worry, it doesn't matter if you decided to enter this space just last week or 2 weeks ago, or if it was decades ago. It'll be fun and easy to look good. We're just asking multiple choice questions based on your core competencies you look to contribute, your level of sophistication, all that kind of stuff. So I hope to hear from you soon. Thanks a lot. Bye. Make sure you 506B me. Any syndicators, make sure you 506B me.
Hi.
Oh, hey, yeah, here's my code. You got your QR code scanner? Okay, yeah, oh yeah, just hold it right in the square there. Okay, cool. And now you hit open in browser.
Okay.
Okay. Are you already logged into 506BME?
Yes.
Yeah, okay, cool. Yeah, so there's my video. So now I'm already on your watch list. So when you get back to your hotel, you can find out what my core competencies are and my level of sophistication. Sound good?
Yeah.
I love your hat. Real estate's a scam. That's really funny.
Yeah.
Nice meeting you.
You too.
506BME, everybody.